Joining me today on the Active Advisor podcast as my fellow colleague and co-host is Dale Korman, Certified Financial Planner, CIMA. Dale is an investment consultant at Harbor, covering the Southeast region of the U.S. Thanks for joining me today, Dale.
Sure.
Our guest for today's podcast is Aaron Gilman. Aaron is the Chief Investment Officer at Independent Financial Partners and the President of IFP Asset Management. Aaron has over 15 years experience in the real estate and investment industries and has leveraged his self-taught Python programming skills to enhance his approach to portfolio management and help his teams reach the next level. Aaron, how are you doing today?
Great. Thanks for having me.
We're definitely going to have to dig into the self-taught Python programming skills. That's something that, I've looked at. I'm pretty good at Microsoft Excel, but that's about it. Quick question. What's the first memory you have related to money or investing?
Yeah, so it has to be leading up to the dot-com bubble. My father worked for Hewlett-Packard. He was a salesman. And so he got into the kind of the worst of the dot-com bubble and bought into all the, internet stocks with no real business model. So that's really where I kind of got my interest, I think, in both the behavioral side and also just the investing side. And, the dot-com bubble is kind of where I really cut my teeth. I think I was probably 13 years old or so I didn't really have a deep understanding of things, but it was a good kind of starting point and kind of anchor point for, my journey after that.
Excellent.
Okay, that makes sense. So before we get into anything else, so you've mentioned to me recently that you have a surgery coming up, and of course we hope it goes smoothly, but for the audience and fellow pet owners out there, do you want to give maybe a public service announcement as to what not to do post-op on when you have a very large dog?
Yeah, I guess I would say if your dog weighs more than 100 pounds, don't worry so much about the picking up of the dog from the surgeon. It's the getting him home that's the tough part, and make sure you stretch.
Yeah. That's, as somebody who has a 100-pound dog, yes, that is key. That is key. May I ask what breed?
Cane Corso for that guy.
Oh, nice.
140 pounds. So, yep.
Oh, wow.
It was so I'm getting surgery and he's basically done with his ACL surgery. So we're trading places.
Oh, well, I'm glad to hear he's doing better,
Yep.
or she's doing better, but, and good luck in yours.
Thank you.
Absolutely.
Wanted to actually really kind of focus, circle back to the CIO aspect of your role. So you're the CIO at IFP and the president of IFP Asset, the RIA version, the RIA side.
Mm-hmm.
You recently entered into a strategic venture with the retirement PPP. Wondering if you could actually give us a little bit of background about IFP, your kind of historical affiliation, focus, and then kind of, where, you've seen the evolution over the past couple of years and where you're at now.
Sure. So we started out as what's called a hybrid RIA with LPL Financial. And then in 2019, we broke away and launched our own broker dealer just so we could kind of control things and really control our own destiny more or less and do the things that we wanted to do and really provide the best experience we can for our advisors. Our advisors are fiercely independent. And so our business model is always kind of a constant pursuit of, integrations and, fully open architecture, so our objective is to be agnostic to the custodians that our advisors want to use. So ultimately, there's a reason why not everyone, does that ultimately, because it's a lot of work, a lot of different moving parts and pieces. And, ultimately, in 2019, we launched the broker dealer. We initially had probably 6 custodians, 1 custodian for the brokerage business. And so, we're now in a phase where we're starting to, we've got pretty much everything we need, onboarded, although there's new technology in fintech that seems like it comes out every week that we, need to evaluate. But we're, I think Pontero is the name of the recent one that we just added as well. So, advisors can essentially charge on managing, defined contribution plans without having to do a brokerage window. But, we're always in a constant pursuit where, the traditional ways of running our business and making money really doesn't work well with our business model. So, from things like partners programs and conferences, when our advisors are able to do their own thing and not have to, we don't fence them in and make them use like 10 money managers. So we have to do things a little bit differently. And so there's not really a precedent that you can really find or mirror in our industry. So that's what we're really honestly constantly trying to do, evaluating other industries. What are some other business models outside of financial services and RAs, that the pieces that we can adapt, whether it's Amazon, how they essentially put products and stuff in their marketplace, and how they sort them and do things that way and pay for eyeballs and views and things like that, I think is a better approach. And so ultimately that's kind of, I guess, just the overarching theme in terms of what we've been working on, kind of where we're heading, and just the constant the constant refining of that process and business model.
That's great. Appreciate that. And
Sure.
that's I want to dig a little bit deeper into that. I've known you since you joined IFP over a decade ago.
Yep.
So kind of to back up a little bit and then sort of look forward, what was it that initially drew you to IFP all those years ago? And you talked about this a bit, but what do you see, Aaron, as the primary edge in your business model?
Sure. Yeah. So what brought me to IFP? I mean, I being the chief investment officer, potentially, when I was 25, I think. So that was the initial that part, and then also the ability to really build something from the ground up. I mean, I love building things and seeing them work and people actually use them. I think that's kind of the main motivator for me, is just building things. More of an entrepreneurial mindset. So I wasn't really ever drawn to somewhere where I had a defined path where I was going to make X here. Do this for 5 years, and then you make Y and so forth, and you get some prescribed bonuses, kind of like the CPA model, where you have a defined benefit at the end of the road and you like everything's set for you. I don't like that. I like having kind of uncapped potential on the upside. And so what drew me in, outside of the role itself, was just the ability to essentially build something and potentially reap the benefits and upside. So I don't want to ever be a place where I'm capped, where I have like a very refined and a very small set of duties that I have to do day in, day out. I like changing things. I like being able to go home and just kind of think about what I want to build next and where I want to take this thing. And it's a great environment for it. So I've never really been bound inside of a box where I just I'm only allowed to do these 3 things. And so that's what really brought me here, keeps me here, and gets me to wake up excited every morning.
Nice. Well, that and your dogs, right? They help.
Well, they keep me up at night. They don't really help me.
Fair enough. So I totally share a lot of the the thoughts and the reasons kind of why you joined IFP and why you're there. We could look forward a little bit, say 3, 4, or 5 years out. I guess where do you see, or where would you like to see the firm, and where do you see kind of yourself working on right now? What are a couple of things, the visions that you have, or a couple of projects that you see kind of coming to fruition in that time frame?
Sure. So that's, kind of a lifetime for me, but, ultimately I think what we're working on is just expanding, our affiliation models. So, as I mentioned earlier, we were a hybrid RA with LPL. And so what we're trying to kind of crack, and, I don't know if it's, ever going to be able to be figured out, but, opening up our platform for hybrids as well. And so, ultimately there's a couple, outside RAs that were with us and kind of rolled out and started their own thing that I still manage money for. And so, conceptually, it's not that hard to kind of think a little bit further and say like, all right, can we open this up so you don't have to join our corporate RA? You have your own. The problem is you end up conflicted if we do it the way that everyone else does it, where, commission business and brokerage business, everyone knows it's a declining, percentage of business mix. And so, do you want to sign on and take, a bunch of direct business, mutual fund stuff where it's a big liability, a lot of books and records, they have to drag around for a decade. I think ultimately what we're trying to think through and understand if it's even attractive to the market is just, can we be indifferent between the two to where we provide services and whatnot on both the RA and the broker dealer side? And essentially, the main, I think, difference and value proposition that we have is, if you want to come and use us as an incubator, whether it's, I think of it as like kind of like a staged approach where, let's say you roll out and you want to essentially, become independent, but you don't want to start your own RIA because it's just too much. So, join a firm like us, build your practice up and then roll out, start your own RIA, remain, have a dual registration where you can still do some commission business. Cause I do think that there are certain products where, in situations where commission just makes sense, it's cheaper for the client. And so I do think having both of those is a good, good arrows to have in your quiver, more or less. And so I think what we're trying to just figure out and evaluate is, is there a way that we can be indifferent between the two? Is there a way that we can bring people and firms on, help them grow? Like I mentioned, let those firms then roll out, start their own RIA. And then if they want to roll out and be completely independent and not affiliated at all, we, are 100% great with that. And we're very friendly, just because we've experienced kind of the other side of that. And so I think the main, aside from us, looking at things a little bit differently, I think the main idea there is just being business friendly and letting you keep what you build with us and take it with you and make it portable. Because that's really what everyone wants on the independent side, just true ownership of your business, so you can, monetize it, build up a legacy without having to worry about, larger enterprise, taking it from you at some point.
No, yeah, I mean, I think flexibility is key.
Mhm.
And it's definitely a nice thing to have, as you said,
Mhm.
arrow in your quiver. Before you arrived at IFP, you spent some time, at a firm focused kind of exclusively on high net worth individuals.
Mhm.
We've all been in this business a while, and I think it's one of those things where if your previous where you're working now may either be a stepping stone, or either way, the previous jobs and positions that we've had have all kind of added to our knowledge base. What is it that you learned there, and it kind of helped you in your current role?
Sure. I was only there for a few years, but I learned, it was the start of my career. And so I learned a ton. I started out in 2008. So the first thing I learned was, from a lot of mistakes that were made that were, honest, just behavioral kind of snafus, I guess would be the term, but just little things that everyone kind of gets into, both clients and advisors. So I learned, right out the gate, some of the things, just, if you get a higher interest rate for something, and it's an alternative to money market, whatever it might be, there's usually some extra risk. And if you can't figure out what that risk is, then it's, you should probably avoid it ultimately. And so that was kind of the first thing. But in terms of like what your original question about high net worth clients, and I did a lot of planning. So I have my CFP as well as my CFA. And so, I learned a lot about the planning side and all the different configurations and kind of components of wealth, and sources of wealth. I watched a lot of, since it was 2008, it was I had interned there for, a year and a half before I graduated as well. And so I knew some of the clients, and was able to see kind of what happened in 08, whether it was like restricted stock units where, someone's entire CEO of a bank, that'll remain unnamed, had almost the entire net worth, spending about $600K a year roughly. And that was like the financial planning assumptions, and all the net worth was RSUs. And so that was all predicated on the stock price of the bank being at a certain level. And so, when 08 happened, I think the bank went out of business and all those RSUs were essentially worthless. And that was, someone went from spending $500-600K a year to, to not having really any, going from a millionaire, multi-millionaire to, almost broke essentially, overnight. And so those types of things where it's just knowing about the sources of your wealth and making sure that, if you're spending a lot, that you actually have some durability and it's not all contingent upon, certain price targets being met and maintained. I also learned, a lot of the services that I'm building on now, essentially to attract high net worth clients. I got the backbone and foundation from my experience there. So just, essentially providing investments in kind of the purest vehicles and access vehicles for things, for whatever the investors qualified for. So QP investors, qualified purchasers, I think that's a big focus of my time. And a lot of the services I'm building now are, surrounding qualified purchasers and just getting them access to things that they qualify for, whether that's hedge funds, private equity. We're also building out custom 1031 exchanges. So, for, people that have a $1 million, 1031 and up, we'll go out and actually vet out properties and essentially do a individual customized 1031 exchange that we essentially split the commission with the advisor on. And so it's very hands-on. We can essentially, find deals that, are attractive to the investor, because they might be an owner operator, and, they might have specific viewpoints that they want to express. And so we can help them do that. And we can also, match and make it so the terms line up. So you don't have to just put people into a DST or some off-the-shelf product that doesn't line up well. So a lot of what we're doing is just like very bespoke, custom-fitted investment solutions and things that we can do because of the amount of money that someone has. And so same thing goes for credit investors too. So we kind of look at it as a multi-shelf approach where we have different services and products and investments that are available, and some things aren't available when you go downstream because you have to, wrap 10 wrappers around it, and it ends up being, too expensive, to where you're better off with just traditional stocks and bonds and things you can get in ETF form. But yeah, I think, did that answer your question?
It does. I want to circle back. You mentioned some of the 1031 and kind of helping clients out with real estate and stuff like that. I wonder if you could kind of really, talk a little bit about that, just because I think that is an aspect that really kind of dovetails nicely into, all the services that financial advisory firms can offer. And I don't think a lot of people know that.
Yeah. So, ultimately I brought on a bright young guy from University of Tampa about a year and a half ago, who his parents owned a self-storage business. And, when he came on board, I let him essentially spend a lot of time hands-on helping them with their 1031 himself. And so, ultimately because that was always something I wanted to build out, was just, a very customized, bespoke solution that was different than what everyone else had out there. And so, I've let him kind of run with it and kind of learn from his own experiences and kind of things he did and didn't like about it. And so I've really let that kind of be the guiding light and let him run with it and kind of build it out as another, service that we offer. And it kind of goes hand in hand. We have a, ability for advisors to refer investment banking business too. And, we get a referral fee and we split it with the advisor. And so that's, we're just trying to build up kind of this nice kind of suite of solutions. But yeah, 1031s is part of it. It's kind of cooled off a little bit, since interest rates have gone up and the real estate market's cooled down a bit. But, last year it was all pretty much anyone wanted to talk about. At that time, everyone wanted to get out of their owner operator, businesses and 1031 the real estate. And so it's been pretty popular, but it's definitely cooled down. And so that's why it's important to have, an array of different services and solutions out there that work well in, different environments, and they're kind of diversify themselves as well.
So excellent.
Yeah. So Aaron, this is great. I mean, so you've given a number of examples, kind of how IFP offers, bespoke, to use your word, services to your advisors and underlying clients. And clearly in your many roles, you are, offering some things outside the box that competitors may not be, which keeps it interesting, for you. So you're trying to keep track of all these. So you're the CIO of IFP, you're the president of IFP Asset Management. You recently got engaged, which is exciting. Congrats.
Thank you. Appreciate it.
You're recovering from this encounter with your dog. You have upcoming surgery. So clearly you have a lot of spare time, right? A lot of extra time. So in all of that spare time, mentioned earlier that you've taught yourself computer programming. So what started that interest? Like, what prompted that direction for you? What are some specific applications that you use in your day job? Can you talk to us a little bit about that?
Yeah, I'd love to. So, kind of like what Bryan mentioned, where he's gotten really good at Excel. That was pretty much where I had been, when I started out. I in college, you learn a little bit about Excel. I wasn't really, like super obsessed with it. Didn't do anything really cool. But when I, started out,
can you do cool things with Excel? If you can, we need to talk afterwards.
Yeah. So, I mean, that's the thing, right? It's like what I did is I kind of maxed out Excel. I was trying to do kind of too much. And I started to look at it and I said, there's probably a lot more I can do if I just, try to learn how to code. And so I'd always viewed, and I think kind of what most people think is the same way I thought when I had friends who were like computer engineers in college, and I always looked at it like, wow, you must be so smart, and they are. But I always viewed it as something that's like way outside of my, potential. Oh my God, I would have to go back to school to learn that. And so I always kind of just like handicap myself in terms of, so I just always kind of veered towards Excel. And then you start looking at Visual Basic, and writing macros and kind of the code in the background. And so, I had built a billing app at the first firm I was at, just to kind of had my hands on a little bit of everything. But they came to me and said, hey, you seem like you're good at Excel. Can you build a billing solution so we can automate our quarterly billing process? Because before it was, they were taking stacks of statements from Schwab and had someone going through and highlighting the balances and then transposing them, keying them into a spreadsheet. And I said, probably let me, I'll take a look at it. And it kind of interested me. And I've always looked for ways to where I could have like an overlapping, something that helps the firm I'm at and also helps me, learn a new skill. It's always, I view that as, even though it might be outside of what I truly want my career and kind of focus to be, it's worth it, I think, in my opinion. And so I've always had that kind of mindset. And so I built, it took me like 3 months maybe, got Schwab to give us data downloads, which is a novel concept back then, but, built out some macros and started to learn the Visual Basic coding stuff. And, looking back on it was a friggin' mess. And I would be shocked if that spreadsheet program worked for more than a year or two after that. But, it saved them, probably 2 months of an employee's time per quarter. So I started seeing that and I was like, wow, this is like super powerful if I can, harness the power of what I just did, but across, RAs and the advisory space. At that time, there wasn't a lot of fintech, right? It was kind of ripe for, especially the smaller RIA practices where, they have a little bit of technology savviness, but it's more on like the IT side, not so much on the programming side. And so, seeing how that worked just kind of really got me interested. And I had always in the back of my mind been like, I should probably just learn how to code. Probably started at IFP, and then maybe within a year or two, I started learning R, which is another kind of statistical programming language. And so I don't know why I chose that. I think it was just, there's a lot of examples that I could, I'm kind of more, I guess, what an engineer would refer to as like a hacker kind of learning process and kind of mentality. I'd kind of reverse engineer to learn and just see how other people are doing things. And so that's how I really started out, was with R, R and then Ruby. So and we can kind of get to that in the next question, which I think is probably about market psych, but that's where I learned Ruby. But I started with R, and, I didn't really know what I was doing. Just like, that's the thing, is if you don't really know how to install things, and you spend most of your time initially learning how to install packages and, getting things to actually work. And so that's where, probably a lot of the time was spent for me. It was just like hacking my way through. And, like I said, my dad worked for Hewlett Packard. So I was used to like, I didn't take any official computer classes or anything, but I was always kind of going in and like just going into settings and like just doing, hacky type stuff and messing around with HTML code and stuff like that. But yeah, it really just started with kind of a curiosity. And, I just really kind of discounted myself and the ability to learn how to code. And so I started with Excel, Visual Basic, capped that out. And then, moved on to R. And then, it took a while to, once you get over that hump, but started building out applications. And it takes a while until you can actually build stuff that is like actually, useful. But after, a couple of years, I was starting to build out, actual apps and whatnot. And so that's where, today it's, teaching people how to code. I've probably taught 2 or 3 younger guys since I, have been able to do so. And so that's helped me like really strengthen up and kind of, teaching them the way that I wish I would have learned, which is like, keep things simple and just keep the setup minimal, and just like, don't, because it just takes forever. And if you know certain things about operating systems, whether it's like better to be Windows or Mac, or iOS, whatever you want to call it, that can make a difference depending on the programming language. And so I think just like spending the least amount of time. And so there's a lot of good development since then that makes it even easier, like Google Collab. where you can just spin up what's called a Jupyter notebook without having to install anything. It's all in the cloud, and you can essentially just start writing code and executing in these notebooks kind of line by line. Yeah, if that was around when I started, it probably would have given me a bit more lift, but I would have learned a lot less about the actual setup, which is good to have, especially when you're launching apps on cloud servers. So it all kind of happens for a reason, I guess, and leads into my knowledge today. And it's pretty widespread. But yeah, I think, once you learn one language, it's pretty easy to start to learn all the other ones as well. So
I would be remiss if I didn't ask, knowing what you know now, knowing where you're at and having taught a few people, what would you recommend if you could look back kind of through all your knowledge and all your experiences? What would be, say, 2 or 3 things that you could recommend to somebody else who's looking to kind of get to be self-taught programming? Is it Python for Dummies? Is it whatever, maybe is that Google Colab? Like where do you think now, looking where you're at and looking back, or would be a couple of different things that you could point out and go, for somebody who wants to do this, check out these 2 things?
Yeah, so I mean, the way I learn is probably a bit different than, actually, I know it's a bit different than the majority of people. A lot of folks prefer the boot camps, the code boot camps and stuff. I mean, I have guys who've worked for me who, have had success with learning that way. I never did great in classroom settings. I was always just kind of disinterested, and I go at a different pace than everyone else. And so I get extremely bored, and it's counterproductive for me, because I just, and I honestly, I see it a lot with the code boot camps. It gives you kind of like the illusion that you can code, and then, you go out and try to do something on your own, and you can't really, because you don't have like the training wheels on anymore. And so everyone's taking those, and they're popular. I think the best thing I would suggest is just, getting in just you got to be hungry and just extremely interested in building and creating things that help you. And so starting to figure out what are some problems, I think that's where I really accelerated. It was just like, all right, what are some problems that I'm like real world problems at work that I'm dealing with, every day, whether it's, inconsistency with the way we're running our equity models, or the inconsistencies with our tactical models, things like that, trying to solve and make those so they're essentially ironclad, and there's no human error, and it's all just essentially rules based. That's a great place to start. Find something day to day that you do, or that some people that work for you or work with you do, that is just mundane, and try to automate it. Just go home in your spare time and literally just go look at open source code's a phenomenal invention. And so I think that's where, if that didn't exist, I don't think I would have been able to learn how to code. So just going on GitHub, signing up for an account, finding a lot of people put their code out there for your eyes to see, and you can pull down and take their code and play around with it and just try to get it to work. And so that's honestly like probably that's how I got the quickest start. It's not easy, and you beat your head against the wall a lot, but it's a lot of debugging and pulling down other people's code and trying to get that to work on your computer. Was like a great way for me to kind of learn from the backwards, from the back end instead of the front to back. But that's the way I prefer to learn, and just going out there and just trying to find a problem yourself and just try to build your own solution. Because if it works, and you get, not only do you essentially, get some uplift at work, and, you get to see people use something you built in a solution, but it really just starts to get the wheels spinning, I think, in your head. And then that's what really drove me and kept me, with the late nights after work, and just kept the drive going.
Nice. So this we're going to pivot a little bit away from programming, although I think I would probably have like 1,000 more questions for you. 1,000. Is there anything in your personal investment philosophy, or IFP's investment philosophy, that you could point to as really kind of being your edge over what you perceive as your competition, or kind of what you perceive as the investment space out there? And you don't have to actually go into anything specific, but would just like to hear like what you believe kind of is your core. And it could be yourself, it could be your team, could be the way you guys look at the world at 2 to 3 degree difference. What is actually what do you and your team get up and pride yourselves on as kind of being your competitive edge?
Yeah, so I mean, I think it really comes down to just the thought process that I have around things, and it more has to do with the behavioral side, where everyone tries to fit people into these boxes, right? And sometimes it's 5 risk-based boxes where it's you're either conservative, you're conservative, moderate, whatever. But the reality is it's just like DNA. There's like an infinite number of combinations of things that you can do in the investing side and personality traits that when you account for them, the way that I kind of approach that problem is by, with all of our, investment, model portfolios, whatever you want to call them. I view them more as building blocks that you can kind of combine together. So on the surface, it looks like there's a finite set of these model portfolios, right? But, when you peel it back, you can essentially combine these in different percentages and use different strategy types. Maybe a tactical might be 20% of a overall portfolio. And then maybe do an 80-20 with the rest. And then for a client that might be nervous, that might be an 80-20 in good times and a 60-40 in bad times. You can essentially account for that by having, a little sleeve that can go to cash when, everything kind of turns south in the markets. And so I think the main edge is just like, it's scalable because we're really just having all these components that we run that are almost like sleeves, right? And then those sleeves can be combined together in an infinite number of ways to create, massive customization. And it's pretty cost effective. And so, I built an app internally that our advisors use essentially, and it allows them to really just, combine these things together and run an optimizer, build it out, incorporate investment personality traits and things like that. But I think that's really, I don't know if that's really so much of an edge. I'm not going to tell you that I have, alpha because we, buy small cap, value stocks and whatnot. But I think, the other part is just our time horizon. I think this day and age, everyone's so like minute to minute, day to day.
Yeah.
Having CMB, I don't watch the financial media or anything like that just because, I like data. So, I'm very data dependent, like the Fed says there. But, ultimately, I think just having even like an intermediate time horizon, especially when you start looking at like quant strategies that are like, minute to minute, no one's ever really focused on like, can I build a strategy that does well over 10 years? It's all just like, what's my, minute to minute tick by tick profitability. And so I think there's a lot of, inefficiencies in kind of that 5 to 10 year, strategy bucket that ultimately no one's really focused on, or like a lot of the quant money and that's whatnot is all like that, tick data, very small fractal type stuff.
No, I think you brought up a great point that if I can, love to actually kind of go a little bit deeper on. I think we are definitely in an age where, people live 30 seconds at a time or a minute at a time. And that can cloud, your judgment. I think it's also shortened as an investor, as somebody who hopes to retire one day, but with 3 young kids, who knows? You do have to kind of occasionally, pause yourself and go, okay, there is a longer time horizon here. What has, the behavioral finance, studying that you've done and kind of research, how have you seen a lot of improvement from doing that, and kind of your ability to relate to clients and kind of help them make better decisions or making better decisions for them?
Yeah. So I think the mistake I made early on was, instead of just learning about myself, I wanted to learn about everyone else's behaviors. Right. And so, ultimately, I think, I did it a little bit backwards. I would say, for anyone that's just starting out, learn about yourself first and your behaviors and your, kind of issues and, figure that out first and then start moving on to others. But, I got to the same place, I guess, at the end of the day.
That's what counts, man. That's what counts. It's all about the journey. It's all about the journey, Aaron.
Yeah. Yeah. I mean, I think I always like to come back to, Vanguard as that advisor alpha study. Not to get super specific and talk about them, but, the biggest takeaway from that is the behavioral coaching component is, the most valuable piece of the advisory relationship. And so to me, I've always been hyper focused on that. All the other little things like rebalancing, like, you add a basis point here, 10 whatever. It's not, when you see something as large as the, ability to add as much alpha just by coaching someone behaviorally, that's super interesting to me. And I think that to me tells me that, really an advisor's, primary role and where I can help is really on that behavioral side. And, when you peel back the layers, there's really only a handful of things that probably affect most people. And it's, spend less, save more. don't jump into, don't chase fads and get into things that are, that you can't value and put a valuation on. But ultimately, and then just stay put. If you have a plan and you took time and developed a plan, whether it's with an advisor or you just did one on your own, you were thinking very clearly when you put that plan in place. And so, be biased towards like not doing anything. I think most of the time, most people are biased towards doing something because they feel like I have to do, something right now. And it's usually in the heat of the moment. It's usually impulsive. And so that's where I see, vast majority of mistakes getting made. And I think we're the most interesting. It's a lot more simple than I think anyone cares to admit. But if you can just be there and keep your client from, blowing out of a portfolio or switching their risk tolerance, get them to stick to their plan. I think that is where it's extremely interesting, and where behavioral finance and personality can help out is finding out how likely someone is to be, prone to certain, behavioral biases, whether it's, if I build them a plan, how likely are they to stick with it? Is it something where I'm going to have to stay on them, and have regular check-ins and things like that? Or are they, going to stay to the plan themselves and I don't have to worry about it? But I think that's where, all the personality testing and you don't need personality testing if you're a good advisor and you ask great discovery questions and open-ended questions and are a good listener. You can learn the same, personality traits as you would with a test of sorts.
Nice. No, I agree. I mean, I think it really kind of comes back to, and I'm going to try to summarize. Really kind of comes back to finding out whether you're a fit for that client, whether that client's a fit for you, right? I mean, I think that's part of it, and not trying to kind of shoehorn every client into, every advisor's approach. And so I think it's great when you can kind of take those extra steps and find, I guess a client that's will agree with you and kind of follows you, and you agree with them as well. What I would like to know is, have you had any findings in the past, or whether it be your kind of behavioral finance research, or kind of in the current kind of your current set of clients or clients that you've talked to, or whether it could be even research on the difference between women and men, and kind of how they approach investing and saving? I know kind of just in my, I'm not near the behavioral finance kind of, I wouldn't, I don't know if I want to call you an expert, that's up to you, but you definitely know more than I do. And I know kind of in some readings that, there has been women typically live longer. So there is something kind of to be said for kind of, working with them as well. And I think that's something that we've definitely seen kind of the finance community start to embrace more and more over the past decade. I think we still got a long ways to go, but would love to kind of get your take on that.
I think I don't have a specific take, but I will tell you just my personal opinion is that, everyone gets lumped in. It's more of like putting people into boxes, right? I think there are men that are great investors. There are women that are great investors. And there's women that are terrible investors and men that are terrible investors. And I think on average, if we're talking about just averages across genders, but, I'm still of the opinion that going, bespoke and actually like learning about someone rather than, being general about gender. Cause I don't know. I've seen so many different variations. And I think where I've seen people get into trouble, or advisors get into trouble, is where they just assume that all people like this are like this. And I think it can help you a little bit with guiding, like maybe mass emails or something like that. But I think if you have a person in front of you, talk to the person in front of you and learn about them, and learn like what they're, are they a good investor? Are they impulsive? How likely are they to stick to a plan that I give them? Do they have anxiety? I mean, men and women both have anxiety. I mean, it's not, and it affects everyone differently, right? And so, not to kind of trash talk a lot of the studies out there, because it's great research, but that's research, right? And you're dealing with very defined groups, and it's very rigid. We're in the real world, and most advisors, you're going to be sitting across from your prospect or client, whatever it may be, whatever the configuration is. I think just learning about them and helping build something custom is not something that a lot of people do. I mean, all the big box firms, it's a factory, right? And it's this comes in and this comes out, and you fit into this very defined thing, and every quarter you get this set of deliverables, and it's kind of customized but not really. But I think we're an advisor starting out, and especially if you have a smaller set of clients and you don't have to, think in in masses. I think, take the time and just be that kind of behavioral coach where you can, really save someone, 3-4 years worth of your fees, just by, helping them out and learning about what affects them individually.
So
Yeah.
the last thing I'll say on this topic, and I know Dale has a good question coming up, is it really seems to me like you're treating the person across from you as a partner in your kind of business, but also journey through this crazy thing we call investing. And I think that's great, and I think you should be commended for that. So, Dale,
Yeah. So
you've got one.
what a concept. Know your client, right?
Yeah, right.
So
We say that, but a lot of times it's like you really like, you really have to know them.
Right.
There is something to be said for it.
And and there's a couple of kind of common threads. So right, you and any professional in this business is always trying to balance scalability of your processes with these bespoke solutions. So it's always kind of a challenge, but I think it's great advice for the advisor to really not forget that it's an individual or a family sitting across from you, and they are all created very differently and have different things that make them tick. So I want to dig into kind of the market a little bit. So you always seem to have a really good grip on what's going on in the market, leading trends and themes. You already mentioned that you don't watch the big publications, CNBC and the like. You like to kind of dig into the raw data more. Can you tell us a little bit more about that? Like what, maybe at the risk of giving up some of your secret sauce, what publications do you like and trust that help you kind of construct your market view for your firm?
Yeah. So, I mean, the big thing is I like capital market assumptions for when I'm firming up kind of, start of the year, more strategic thinking. And so, the JP Morgan capital market assumptions have been around for a long time, and they really kind of, dig into the actual details on how they arrive at their assumptions. BlackRock recently came out with, published more details around it and made a really cool interactive site. So those are the kind of the two pieces that I use to just see 10, 15, 20 years out, strategically, what's out there, what is, I start I run, my own optimizers to take this capital market assumptions and run, hundreds of different iterations of what does a 60-40 look like if, I run based on, JP Morgan's capital market assumptions with no constraints. What if I just look at, what does the equity allocation look like if I run, a max Sharpe ratio type of optimization routine? And, you get some pretty funky results. So, you have to end up, constraining optimizations quite a bit. And so it's just an exercise I like to go through, annually when those come out at year end. So that's kind of more strategic thinking. The rest is really I use, St. Louis Federal Reserve Fred website and API. So, I mean, it's all free data. It's phenomenal. So essentially, I've been, I was kind of early trying to use data for investing and coding and all that. And so there was Yahoo. I remember when I was first starting coding, Yahoo Finance was like the free data source that everyone used. And there wasn't really a whole lot of options. And then one day Yahoo Finance cut the free data off, and it was like, it was a complete chaos in the quant investing world. And so, when that happened, and I'm sure it was true for everyone, I just looked at it and I was like, all right, I should just probably start paying for data, being smart about it, because you can rack up data bills real quick and get some nice recurring fees. And so Quandl now, I think it's called NASDAQ data or something like that. It's a good place you can start kind of playing around with data sets and whatnot. But I just like taking the data and, I think the biggest thing I've learned over the years is, I started out trying to learn and know everything every minute of every day. And so that's, 24/7 having CNBC or Bloomberg TV on. And, what I realized is that it's better to, know what not to pay attention to more so than what to pay attention to. And so I like just controlling my own flow, not dealing with headlines, because it's just when we're talking about behavioral stuff and kind of my behavioral, roadblocks and issues that I have, the headlines and kind of sensationalist stuff, it's distracting for me. And so I ultimately have a finite set of things that I look at, and I don't let those change based on, a headline comes out that says, X statistic is showing this, and it's, there's always something new and some new way of proving, a bullish or bearish thesis. So I think it's like over time, just refining that and just staying true to it. And, it's not to say I don't add new things to my arsenal every so often, but it's a long process, and I got to have some proof and show that it actually works over time. But I think that's the biggest thing. And I think in our industry specifically, and I'm sure it's true across other industries, everyone loves to just copy other people's, work and charts. You see snippets of the same charts flowing through, hundreds of publications, and no one ever digs in and says like, maybe I should check that data and like try to replicate it and do it on my own. And so I still do that. If I see something that looks interesting, a chart or a stat, I go try to grab it myself and run the numbers and see if it's actually legitimate. And you'd be surprised in our industry how little of it that you can actually recreate, and how many of these things make themselves onto mainstream media, and you just takes an extra hour or two to just dig into it a little bit and fact check. And I guess it's probably the same thing with fake news that globally that everyone's dealing with social media and fake posts getting reposted. And it's the same thing in our industry, where people take stuff that has issues in terms of just the way it was presented and correlations between things that aren't legitimate. And I think that's where I focus most of my time, is just making sure and fact checking everything. And if something's legit, then I think I'll roll with it then and incorporate it into my daily flow. But that's kind of where I'm at on that.
Oh, awesome. So it sounds like you have a healthy skepticism of kind of just the general broad market, thought distribution, which is great. So do I. And then it does take some time to try to find that kind of nugget sometimes, that person that kind of looks at the world a little bit different. What is what you perceive as just a general consensus market-wide view, or portfolio allocation decisions, could be something like 60-40, that you see or you talk to your colleagues across the country that is kind of in the norm, I guess, or widely held and believed, that you disagree with?
Yes. I mean, I've kind of been, I would say there's a top three for me on that. I think the big one that I always hear, and it's more so with clients in terms of like their fears and biases, is Europe's still, a big no-no for a lot of investors. That's, probably the number one request that I get from people when it comes to customization is like, I like what you're doing, but no Europe exposure. And it's all has to do with, Russia, Ukraine conflict. And, ultimately when everyone's on one side of a trade, usually the opposite happens. And so I think that's, we're kind of probably well into that playing out a little bit here, but that was probably my, number one thing, at least last year. And it didn't really have anything to do with much, really anything with the war and conflict over there, and more so just the, my experience with, the imbalances of viewpoints and consensuses in our industry specifically. So that'd probably be number one. I think number two is probably just, and this is already playing out as well, but value stocks just globally. I mean, I think Dale and I might have been talking about this recently, but, there was, GMO put out some numbers on where they broke, emerging markets, IFA and the US through the Russell 1000 and quintiles by valuation. And so what was interesting is, in the US, the bottom, quintile, the cheapest stocks are, I think it was like the fourth percentile relative to their own history in terms of the valuations. And then all the other four quintiles were essentially, very, 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 very overvalued, even kind of that GARP-y, growth at a reasonable price, very expensive relative to its own history. So to me, this still, and then in Europe, in IFA and EM, it was actually the bottom two quintiles were kind of the cheapest they've ever been relative to history. And then those top three were extremely expensive still. So I think the, consensus, I think, is still, on these like cool growthy tech companies, which I'm not, again, I'm not trying to paint a broad, stroke here, because I think there's differences between certain growth companies and tech stocks, but there's a lot out there that are still, I think pretty overinflated. And kind of reminds me of, the dot-com bubble, which, we started out this podcast talking about it. Took about 4 years to play out until everything all the excess was kind of let out of the system. What are we like? We're about a year and 3, 4, 5 months in, potentially. So yeah, I think value is still kind of my favorite, just global value, whether it's EM, IFA, US. I think that, it might be a bumpy road that doesn't, it's not going to be a linear value outperforming growth, but those 4 years after the dot-com bubble, it was value outperformed growth, and there was about 4 drawdowns that were pretty big for value in between. But, it held up through that recession that we had in 2002. I think it was, 2002. No one ever really talks about that recession. And so I think we could maybe be in a similar situation today where everyone, forgot about, all the value, boring stocks, and they want something that's super cool and makes, some new technology. And I think there's some legitimacy to it, but it's boring. And, I think that's why it works, but it'll take some time to play out. And, I think the third kind of view that I have is just the S&P 500, the top 10, 20 companies is still way too over concentrated.
Yeah.
So I do think there's probably some antitrust stuff that's going to come through at some point where, maybe Amazon breaks up, maybe Apple breaks up. I think there's got to be some, something's going to have to give with those, let's call it the top 10 just to make it easy. So I've been veering away from cap weighted US equity indexes, the last year and a half or so, more towards equal weight, other weighting schemes. I like active management, but I think, people confuse active management sometimes with, alternative index weighting, ways that you can weight stocks with an index, right? And so I think to me, that's like a good middle ground between, passive, which I think most people think of passive and indexes as market cap weighted stuff.
Yeah.
And it's, if you want to build a low cost, bare bones, super cheap portfolio, cap weight your equity and bond, and you'll be at the cheapest in the industry. But you don't have to go full active. You can kind of step over and kind of take, do equal weighted S&P and just do little kind of changes here and there. And I like that approach. And I think it's been pretty useful over the last year and a half or so.
No, definitely. I mean, I think I can remember reading stuff back in 2021 about the early part, the death of value investing.
Mm-hmm.
It's kind of it is interesting how when you kind of reach that bottom point where everybody's chucked something aside, how it's just to find its way back and become flavor of the month is not the right word, but kind of all of a sudden that genre of investing comes back in style and starts kind of paying off again. Not that it ever didn't, but it becomes more popular.
Sure.
We've all been in the business a while, and I think we all can kind of look back at our careers and say, well, I wish I would have known that. I wish I didn't do. Yeah, I wish I didn't do this. What is one skill that you would to have told yourself, that you would like to wish, an advisor or somebody like you in your position had told yourself before you started this journey in the business?
Yeah, I think I mentioned it earlier, just learning about yourself first and figuring out where your biases are. And I think that, spending time on that up front will enable you to help others better too, and help you build your practice to be, more resilient. Because I think, biases show up everywhere, behavioral biases show up everywhere. And I think, whether it's like, applying the same, investment risk tolerance to all your clients because you believe they should be X, Y, and Z, it's, there's a lot of things that you can do, and that are helpful when you know yourself first before you start out and try to help others. Put your whatever the air mask on the airplane, but put that on first, before you start helping others so you don't pass out.
Yeah, well, that's always nice. Yeah, that's good.
Yeah, good advice.
Yeah, exactly right. It's funny they say that, so anybody who flies frequently, you've heard it so many times, you're just kind of like, but it is something that should, you kind of, that's why they say, please read your card, right?
Yeah.
I know we've talked about it briefly, but you here at Harbor, we believe wholeheartedly in active management. And I think every financial professional has their difference of opinion, which is kind of what makes this business great, because all of our clients have differing opinions. Mm-hmm. What is your philosophy? I know you've mentioned you liked active management. Is there a place, and I know this kind of dovetails into some preconceived notions, but is there a place that you feel that it adds, or you believe that it can add really significant alpha to a client's portfolio or significant, drawdown performance?
Yeah, I mean, I think on the fixed income side is always the, kind of obvious go-to for most folks. Yeah, so I think the fixed income side's pretty good, and I think large cap's tough for that space, quite honestly. But I do kind of like the multi-cap value manager type approach for the active. I think that's great, and global value, special situations type approaches as well, I think is great. Having active management for that as well. EM, I know there's a lot of like cool ETFs out there now, so you can kind of, express your view or avoid certain areas like, ex state-owned enterprise type stuff. So, I even myself find myself having trouble sometimes differentiating between active and just, different filtering, processes on stock universes. And I think they're kind of similar to a degree, and the lines blur, I think, ultimately. So I almost view, anything that's not cap weighted, almost as active to a degree. It's just, is it a person that's doing the active management, or is it a filtering criteria that you put in place that just consistently happens over time? But yeah, I mean, I think ultimately it has to do with the efficiency of information and, analyst coverage, and how efficient, is this actual like specific, asset class that I'm looking at. Does everyone have the same information? Like the efficient market hypothesis. I think there's it's kind of helpful to think in that context and just see where it makes sense and where you should pay up for active and different things that aren't cap weighted, really.
Excellent. Well, listen, I really appreciate you taking time out to talk with us today. And one of the things we want to do is, how can people find you? Social websites, what's your website address?
So I'm a bit of a pariah in this regard, but I have LinkedIn as my the only social media I have, honestly.
Okay.
Yeah, I might have an Instagram account, but I don't even have the app on my phone. So it kind of goes in the same vein as not watching CNBC. I don't pay attention to social media either. I just do my own thing, and I feel like things will take care of themselves. But
Fair enough.
my fiance handles social media. She sucks down enough screen time for the both of us.
Well, then fair enough. What is your company's website then?
IFpartners.com is our website, and then my LinkedIn is just Aaron Gilman. So those are the two spots where you can find me.
There you go. Perfect. That's that's a wrap on that. And now we're going to go to I guess we can call this intro to Aaron Gilman in 60 seconds, or we can call it the lightning round. I'll leave it to you. So one of the things we want to do kind of is obviously we've had kind of a good financial discussion for a good bit, but we want to kind of really find out more about you and kind of what makes you tick, and kind of what you like. And so we're going to be asking you a couple of quick fire questions here, variety of topics, and we only have a minute to respond. So we're going to kind of, if you want to say pass, fine, but we're going to fire them out at you. I think you've been great so far, and we're really happy to have you on board. So are you ready?
Let's do it.
Nickname?
Gilly.
Hobby?
Basketball, tennis.
Cats or dogs?
Dogs.
Best book about investing or finance?
Liar's Poker. I like that one starting out.
What would you be doing if you weren't sitting across from us right now and being an advisor?
Probably maybe an engineer or computer programmer, software engineer.
Favorite musical artist or band?
On my radio in my car, I listen to stand-up comedy exclusively. So
okay.
I'm not a big music guy either.
Bucket list travel destination?
Probably Fiji would be cool, I think.
Hidden talent?
I'm actually really good at handiwork, and kind of I do it myself in terms of like my home projects and whatnot. So I know how to pretty much do the electric and plumbing and all that stuff, kind of self-taught as well. YouTube.
Office or remote?
Office.
Best lunch spot near your location?
I'm not a lunch guy, honestly. I usually I work through lunch, typically just a little handful of almonds.
60-40 portfolio, a classic or a relic?
I think the concepts are still true, but I'd say classic.
Would you rather have dinner with Warren Buffett or Elon Musk?
Oh man, definitely Warren Buffett.
No, I think we covered it. We covered a lot of ground there. And yeah, to Bryan's point, really Appreciate your time, especially in the lightning round, to get to know you a little better on a personal level, at least for our audience's sake. This is great. Really appreciate all of your time, sharing your story with us, and a lot of really good nuggets in there for our audience to glean, for sure.
Yeah, thank you for having me.